Hello everyone, welcome back. My name is Arias, and today we're going to talk about the first quarter earnings results from GNGO Bioworks and LMND, and what implications they have for the long term of their companies. Don't forget to like and subscribe if you enjoy this type of content, and leave me video suggestions and feedback in the comments below. And without further ado, let's get into it. First, we'll start with LMND. LMND reported solid IFP growth of 66% year over year to $419 million, made up of 37% customer growth to roughly 1.5 million customers and 22% growth in premium per customer to $227 per customer in premium. Gross loss ratio was high again at about 90%, but down year over year due to lapping the Texas freeze event in Q1 of last year. 90% long term is still too high to be profitable, and LMND needs to return to the 70 to 75% range that they had for a few quarters around when they went public. And as we'll see later on in management's comments, we have reason to believe they'll do so. These are the key metrics that make up LMND's growth story, and we'll come back to them in a moment after we look at the takeaways from their conference call. Later in the shareholder letter, they called out some positive early signs from their launch of car insurance in Illinois. They saw annual dollar retention increase dramatically in Illinois following the release of insurance from 82% to 90%, a good show of how accretive car insurance is to their business. They also saw their first 4 product bundles, which outspent single product customers on a 9-to-1 basis, while double and triple product customers outspent single product customers on 3-to-1 and 7-to-1 bases, respectively, showing a dramatic increase in premium when bundling takes place. This is a big part of the growth story going forward, as LMND gets free additional premium for little to no additional marketing spend, but we'll talk about this much more in depth in a moment. Now, for some of what I saw as the important takeaways from the call. To start, management said that they expect their new business that was acquired during this quarter to be well within the 75% long-term loss ratio goal. This should be no surprise to those paying attention, but is nonetheless good to hear as they still believe they're on track to hitting that goal. Management also said their loss ratio has been influenced by inflation as rates change slower than the cost of claims increase. However, they have filed applications to raise rates back in line with this and have requested, where possible, to have automatic petitions to increase rates to stay in line with future inflation. Another interesting point is that they said they were not seeing any significant differences in the trends that they saw in their first car insurance market as in their second tend to see, which is of course an excellent sign of the scalability of this product. They mentioned that most of the new customers to car in Illinois were previous LMND customers that incorporated car insurance to their insurance with LMND, meaning there was little to no customer acquisition cost for the new amount of premium. They also noted that they had already built out much of their product support team for the full launch of car, meaning that there will be less expenses going forward related to that product launch. In general, I think this will be a key factor in profitability, is that they have already spent the effort to build out most of their major product lines, meaning their R&D can remain relatively flat compared to their revenue growth going forward, giving them operating leverage. I think the addition of car insurance to LMND's suite of products will be excellent for their business and core metrics. Speaking of which, let's talk about a LMND bull case through the lens of their main metrics. If they can get their loss ratio down to the 70 to 75% range, which I think they will as they grow a larger, more mature book of business and steadily continue to grow the premium per customer, then the future of LMND is very bright. One important nuance is that the two vectors of growth should be looked at through different lenses when deciding how accretive that type of growth will be to LMND's margins. Premium per customer growth should be very accretive to LMND's margins and overall business, as a significant portion of this growth comes from existing customers purchasing multiple policies with LMND, which requires little to no additional marketing spend by LMND for the additional premium, and there are 3 ways for this to happen. One way will be incorporation of car insurance, which typically carries much higher annual premiums for customers, with companies like GEICO and Progressive having annual car insurance premiums of $515 and $1,207 on average. Metromile, whom LMND is acquiring, has a significantly higher premium per customer at $1,100 per policy insured. As LMND adds car insurance customers, because car insurance is typically more expensive than other insurances like renters or pet, their annual premium per customer will increase, but this will not have as accretive an effect on margins or LTV to CAC ratio, as this will require marketing spend. Another way their premium per customer will increase over time, but without marketing spend, is the effect of bundling. LMND already has 1.5 million customers in renters, homeowners, or pet, and effectively none of them have car insurance with LMND. However, many of them do have cars and would bundle that insurance with their already existing LMND insurance, or would bundle their renter's insurance with their pet insurance, if it were both available in their state. Both of these would lead to additional premium per customer for LMND, but with no marketing spend. Now, a quick detail on why that is so key. If LMND can add extra premium per customer after they sign up, while paying a fixed marketing cost, that would allow them to pay higher marketing costs than competitors for the same customers and still make money because they can sell the extra insurance policies. This is one of LMND's key advantages versus other next-gen insurance companies, as they already have a full suite of products to sell to customers. This will give them a short-term advantage that will allow them to capture market share and hopefully outlast their competitors. The third way that they can add premium per customer is via predictable lifestyle upgrades as customers age. The prime example of this is a consumer that starts out as a renter and then buys a home or a condo and stays with Lemonade for that insurance. This would drive a multi-fold increase in their premium for that customer, thereby increasing the premium per customer, and this will naturally occur for no additional marketing spend as Lemonade's early customers mature. For example, the U.S. national average cost of homeowners insurance was around $1,300 per year, while renter's insurance for the same period was less than $200. From these three reasons, I see a clear path for Lemonade to have an average premium per customer around $700 by the end of the decade, if not more. Now, the other lever for this growth is the number of customers Lemonade has. This is the key for their long-term potential. How many customers can they acquire? Management has repeatedly stated that they refuse to add unprofitable business, meaning that they will only spend as much on advertising as it takes to acquire a profitable customer. This means that their long-term growth is constrained by the number of profitable customers they can add. This is where their web-centered asset-light business model comes into play. There are a certain amount of profitably reachable customers in every market. It will be key for their long-term growth for Lemonade to enter as many of these markets as possible, and they will be able to do this due to their flexible and scalable infrastructure. If a traditional insurance company wants to enter a new market, they would typically have to set up a new network of agents to sell the insurance and broadcast their trustworthiness with a new massive building by their name and saturate our TVs with ads. This is obviously massively expensive, and it's largely why insurance companies don't operate in both the US and Europe, mostly sticking to one side or the other. Lemonade is different. All they need is regulatory approvals to get started in a certain jurisdiction. Then they unlock their website and app to be geographically available in that area and start a targeted online ad campaign. From there, they relentlessly optimize for what works in that area, but that is significantly less overhead than is required for a traditional insurance company to open up in new jurisdictions and expand Lemonade's potential opportunity. They are already in part of Europe, and as I see it, it's a done deal that they will eventually encompass most, if not all, of Europe. But could they eventually spread to Asia and tap into that massive market opportunity? Potentially yes, although I'd need to learn more about the insurtech competition already present there. Customer growth is the key metric for Lemonade going forward, and I will keep a close eye in the years to come on this metric. My simple long-term model for Lemonade is that by 2030 they get 10 million customers, 27% growth every year from now until then, and earn an average of $750 per person in premium, 13% growth every year from now until then. That would result in $7.5 billion in IFP in 2030, a 43% CAGR over the ensuing 8 years. If we value it at twice sales, that would yield a $15 billion valuation, or if we assume just 5% drops at the bottom line and give that a 40 multiple, that would also yield a $15 billion valuation. I encourage you to play with the multiples and assign what you think best fits, but I think the underlying metrics are quite reasonable. The average premium per customer is significantly lower than the same metric for State Farm, Progressive, or Metromile, and you could argue that I could place the average premium per customer at $1,000 or more, which would significantly boost the valuation. I left it there, however, because Lemonade has typically had a higher proportion of renters, which is a lower cost insurance, bringing down the average. Number of customers is a bit more interesting to justify, but a quick Google search reveals Progressive has over 18 million customers, Allstate has 16 million, and GEICO has 17 million. Effectively, I am projecting Lemonade to become 2/3 of one of these companies. But remember, these American giants are just that, American, while Lemonade has their scalable online nature and can reach Europe and potentially other markets all over the world, meaning that they can be many times bigger than the states and farms of America. This is my simple model for Lemonade, and of course, it's just to get you thinking, rather than any sort of financial projection. My more detailed models have them getting well beyond that $15 billion valuation, but $15 billion is plenty to make a worthwhile return from the roughly $1 billion market cap today. I've bought some more Lemonade over the past month or so, but I will likely be waiting for it to return below the $20 a share mark before I pick up any more. I'm still looking to add another approximately 1/3 to my position before I will start to think of it as all built out. I'll keep track of Lemonade closely over the coming years to make sure that they have enough cash to let that play out and that they continue to hit my growth metrics. Now let's take a quick look at GNGO Bioworks results. GNGO reported total revenue of $168 million, up over 250% year over year, made up of $21 million in foundry revenue and $147 million in biosecurity revenue. The foundry revenue came in fairly light and was actually down 5% year over year, caused by a lack of downstream value recognized in the quarter. And while this result is disappointing, due to the lumpy nature of programs at this early stage in their business, it doesn't concern me as long as they hit their yearly target. They expect this to recover significantly for the rest of the year and are still projecting to hit the $165 to $180 million in foundry revenue for 2022. Biosecurity revenue was up huge year over year, and they raised their full year outlook to $210 million from $160 million. Biosecurity contributed very nicely to the bottom line with a 42% gross margin and helped them achieve an adjusted EBITDA loss of only $2 million for the quarter, which is tiny for a company this early in their ramp and investing as much as they are. R&D was down year over year despite a massive one-time non-cash stock comp expense being included. I think it was down due to the lack of R&D going into biosecurity, as well as some moderation by the team due to a tougher operating environment. G&A was up over 100% year over year due to the same stock comp charge. GNGO's cash position remained strong at over $1.5 billion on the sidelines to sustain GNGO's operations deep into the future. In their SPAC presentation, they project adjusted EBITDA losses of approximately $150 million per year, which would give them a decade to get profitable, despite projections of profitability in 2025. This gives me a feeling of security in GNGO despite the market conditions. Finally, for some takeaways from their conference call. First, they completed their acquisition of FGen, a Swiss company focused on the ultra-high throughput screening using nanoliter reactor technology. Their technology should be broadly applicable throughout GNGO's programs and will enhance both their cell screening and directed evolution capabilities. This is also indicative of an overall acceleration in M&A activity that management also referenced on the call, which I'm excited for, as I think GNGO, with their strong balance sheet, may be able to scoop up some useful technology at bargain prices. Speaking of more M&A, they talked a bit more about the Bayer Join Bio deal, but there weren't any more details that I noticed. I talked much more about this deal in my latest video, which will be the first link in the description, but to make a long story short, I think it is an awesome deal, and I can't wait to see what they will do with these expanded capabilities in the biological space. Another note from management on the call was, despite the increase in related party revenues as a percent of mix for the quarter, this should not be considered a trend going forward. They also remind us that they do not manage related party mix and should expect it to vary going forward, but generally be down. They also talked about piloting new biosecurity technologies, such as localized wastewater testing and even air monitoring. These are early on in their development, but may give us a glimpse into how they foresee the biosecurity business continuing as the impact of COVID continues to fade. Finally, management reiterated they were focused on continuing Knight's Law cost declines, as well as satisfying customers with their work that they are doing, rather than any of the other external factors that they have little to no control over, which is, I think, a good attitude to take up. Thanks for watching. What do you think of Lemonade and GNGO's future chances? What are your projections for Lemonade in 2030 in terms of customers, IFP, and valuation? Do you think GNGO is a good buy right now? Let me know in the comments below. Thanks again for watching, and have a great rest of your day.